Let's jump right in. Welcome back to The Explainer. Today, we're unpacking a concept that absolutely flips traditional market wisdom right on its head. You know, if you think trading is all about just hunting for that next big winner, well, the math is about to give us a pretty brutal reality check. We're going to uncover the undeniable, hard numbers behind drawdowns and show you exactly why, in this game, defense is actually your best offense. Okay, let's dive into this with a number that honestly should make every single market participant just stop dead in their tracks. 900%. Seriously, just think about that for a second. Why on earth does a 90% loss demand a massive, frankly almost impossible 900% gain just to get back to your starting line? Well, the answer lies in exactly how losses compound against you. And this brilliantly illustrates the core problem here, right? The completely asymmetric nature of drawdowns. Look, a 10% loss requires an 11.1% gain to recover. Manageable, totally fine. But man, math can be cruel. As those losses grow, the hole gets exponentially deeper. If you hit a 50% loss, let's say dropping from 10 grand down to $5,000, you don't just need 50% to recover. No, you have to literally double your remaining capital. A 100% gain just to break even. So, this brings us to a highly actionable shift for your mindset. You've got to recognize that the very moment you hit a 50% drawdown, the entire game has changed. You're no longer trading for profit. At that point, you are trading purely for survival. The math has shifted against you so violently that capital preservation literally becomes your only logical objective. So, to wrap up this first concept, I really want you to burn this key takeaway into your mind. The deeper the hole you dig, the steeper the walls become. Drawdown isn't just some temporary loss of capital. It's a mathematical hurdle that actively accelerates in difficulty the further you fall. All right, let's shift gears for a second and challenge a pretty massive assumption. What actually happens to your wealth if you average a 0% return over a couple of years? I mean, most people would naturally assume that you just break even, right? You end up exactly where you started. Makes sense on paper. Well, wrong. Actually, we have to unpack the simple arithmetic average versus the geometric reality. Think about it like this. Say you start with $10,000. In year one, boom, you hit a massive 50% gain. You're sitting pretty at $15,000. But then, year two, you take a 50% loss. Now your simple average, sure, that's zero. But 50% of that new $15,000 balance leaves you with exactly $7,500. Geometrically, despite a quote-unquote 0% average, you just lost a quarter of your wealth. Crazy, right? The actionable solution to this mathematical trap is actually pretty straightforward. Lower variance equals higher survival. You've got to limit what we call the volatility tax. High variance returns, even if they include some incredibly large, flashy winning trades, are almost always going to mathematically underperform steady, lower variance returns over the long run. And why is that? Because those deep drawdowns significantly impair the geometric growth of your capital. Which brings us right to our key takeaway for this segment. Volatility is a direct tax on your long-term compounding. Literally. If you're out there allowing wild swings in your account equity, you are directly sabotaging your own ability to grow wealth over time. And honestly, that's regardless of how amazing your winning trades might actually be. Okay, so that brings us to another honestly terrifying number, 50%. Now, as we already established, it requires a 100% gain to recover from this. But it's also a massive psychological breaking point. When a retail trader hits a 50% drawdown, the psychological pressure usually kicks in, and that initiates what we call revenge trading. You know the feeling, trying to just make it all back in one single desperate go. And this is exactly what the industry calls the risk of ruin. It's the absolute point of no return. The core problem here is reaching a stage where your remaining capital is just so small that standard rational risk management goes right out the window. I mean, if you're treating a 30% loss with the same casual attitude as a little 5% dip, you are blindly walking right toward a cliff. So, what's the professional solution here? Well, it turns out it's defining a hard stop trading level at a 15 to 20% drawdown, and doing this before you ever even enter the market. When the pros hit 20%, they literally cease all activity, step away from the desk. Why? Because at a 20% loss, that 25% recovery requirement we talked about, it's still mathematically manageable. Because listen, if you fail to respect that boundary, and you slide all the way down to a 90% drawdown, here is the grim reality of your takeaway. You are going to face two catastrophic choices. You either take massive risks which, let's be real, is basically just gambling at that point, trying to hit a miraculous 900% return. Or you accept reality, trade conservatively, and spend literally decades just trying to crawl back to your starting balance. Now, tracking these metrics to ensure you never hit that point of no return requires absolute precision. So, quick shout out to our sponsor, TradingView. Save $15 using our referral link in the description to get the standard in charting your trades. Seriously, it's the absolute business standard. Now, what's really interesting about this is when we look at the actual mechanics of a losing streak. Look, a drawdown is rarely just a single catastrophic trade, right? It's almost always a series of consecutive losses. But how exactly do these losses compound in reverse against your account equity? Well, it entirely depends on your contract sizing model. If you use fixed fractional risking, which is where you risk a percentage of your current balance, your position sizes naturally shrink as you lose money. It's amazing. This acts like a mathematical parachute, literally slowing down the rate of your drawdown. Now, compare that to fixed lot risking, where you just trade the same number of contracts no matter what your balance is. Guys, that is an absolute accelerator to ruin. So here is your mechanical solution to actually surviving a losing streak. Are you ready? Risk 1% of your current balance, not your starting balance. It's so important. Think about it. If you're in a 20% drawdown and you keep trading the exact same fixed lot size based on your initial capital, a trade that originally risked 1% of your account is now risking 1.25% of your remaining equity. It's snowballing. And the key takeaway here perfectly summarizes the fatal flaw of static position sizing. If you continue to trade the same number of contracts, your risk percentage increases as your account decreases. You are quite literally accelerating your own ruin at the exact moment when you can least afford it. Okay, so let's flip it and look at the absolute opposite scenario. 5.26%. If you experience a minimal 5% drawdown, you only need a 5.26% gain to recover. That is a highly manageable number. It's just a routine market move, totally achievable without having to use crazy excessive leverage or relying on sheer luck. And that brings us to the core premise of our final segment, the efficiency of recovery. You really should view the avoidance of large drawdowns as a growth strategy in and of itself. Seriously, a quote-unquote boring trader who prioritizes defense and never loses more than 10% of their account, they have a massive mathematical advantage. By keeping their drawdowns in a low impact zone, they ensure their capital compounds with just incredible efficiency. Let's move to and see how this builds into an actual daily routine. Here are 4 super practical steps for monitoring your drawdown tolerance. Number 1, track your peak equity daily. Number 2, calculate your current percentage distance from that peak. Number 3, compare your current drawdown to your strategy's historical maximum. And finally, number 4, identify your recovery multiple. You need to be constantly acknowledging the exact percentage gain you need just to break even. At the end of the day, a loss isn't just money gone today. It's the extra effort required tomorrow just to get back to zero. Are you ready to really master these mechanics? For additional solutions and to dive way deeper into these strict scaling rules, make sure to grab your copy of The Funded Micro, Modern Future Strategies for the Prop Firm Era at franksreport.com. Keep your drawdown small, folks, and protect your earning potential. But I'm going to leave you with this one thought. If defense is truly the ultimate growth strategy, what other traditional trading rules are actively working against you right now?